Hello everyone, this is Jeffrey Cohen, here to talk to you about Chicago Quantum and to welcome you to week 17. And I'm very excited actually to be able to speak to you about the markets. I'm wearing a Chicago Bulls shirt because there's some bullishness in the market, but I've also brought my Chicago Bears hat because there's also some bearishness in the market. And today we're going to talk about the struggle between bull and bear. And I actually think that's very important for you guys to be thinking about this week. We have a balanced week. So first we're going to talk about the firm. Let's go. Okay, what about the firm do we want to talk about? We want to talk about Chicago Quantum. Let's go. So we're now running NASDAQ S, which is NASDAQ Capital Markets in our runs. That takes us up to over 4,500 stocks. We can now run 3,600 stocks at one time through our model and pick the best portfolios, the most efficient portfolios, according to the Chicago Quantum Next Score. In terms of validation, it's important, right? So we end up with 3,600 or more shares that are fully validated. And so I've had people ask, what do you mean by fully validated? Well, they have to have traded all year. 1 year, at least 100 shares a day, according to the data source, the market data source we have. The price can't be negative. In fact, the price shouldn't be a penny stock. We normally run at like 25 cents at the minimum. The stock has to have been above 25 cents and under $1 million. And you can play with that as well. We've added a new thing, which is the stock can't have gone up more than 300% in one day or dropped 3/4 in one day. And I realized what was happening. Well, first off, there are some stocks that we should be looking at that it dropped, such as AMC, the movie company. That's just a lot of movement. But in other cases, you get a lot of restructurings where the stock was trading at like a quarter, 50 cents, $1, and then all of a sudden it's $30. Well, they restructured. And restructuring is not a gain. Restructuring is a restructuring. So we're working on that, and so we have a number of things that we're doing to test to make sure the stocks are good stocks with enough data to evaluate for the Chicago Quantum Net Score. So big news, 4,500 plus. We have not updated our website. So right now for your $750, you've got 4 exchanges, but we'll be updating it to incorporate the 5th. It takes a lot of work. It's using all of the capability of our new server. So 4 times the processing power. We're adding, 750 stocks, and that's enough to use it up. So just what it is. The second is our bespoke reverse simulated annealer is still awesome. It still improves on the best answers of all of our other solvers. We let it run a long time, and it's working hard, but it's pretty cool that we found a solver that works consistently every single time, improving on the best answers. So, question for you all. What do we do next? What's the next solver? I'm pausing because I want you to make recommendations, and if you'd like to volunteer or get involved in our firm, we can start paying a little. Give me a call. You can find it on the website, how to email me or call me. But new solver types. And if you have a level of expertise, that's great. Now, I remember we talked to firms that have solvers. That's not what I'm looking for. I'm not looking to spend 30 grand on a proprietary solver. We could. In fact, I had a client or company, not a client, company say for $100,000 to $400,000 you can use ours. That's great. Reverse simulated annealer, 1-page code, does great. So I'm more looking for, who wants to work to create proprietary solvers that we can use with clients and basically charge the clients for our time and make a profit. And if it means we have to bring some proprietary code, kind of reminds me of the old SAP days where a great SAP consultant had their USB with their kind of trick code with their scripts. They could do a lot of things in SAP with scripts. So this is how I look at our solvers. They're like scripts that we can use with a client and not have to have that baggage of, well, if you want to hire us, you need to also hire this tech firm for $100,000. I can't imagine that's going to be helpful. So maybe over time. We met with D-Wave. Yay, I love D-Wave, by the way. D-Wave quantum annealers. Met with D-Wave, and they've made some enhancements and some suggestions to help us pick stocks better on their latest system. I want to thank their marketing person for putting us in touch with their technical people. I really appreciate that. We will always be indebted to D-Wave for being so nice to us when we started our firm. And although there's no commercial relationship between us, we are big fans of D-Wave, and we will do what we can to help them. Oh, hey there. I got a friend out there. Hi there. Ask me anything. Cool. Love when that happens. People send messages. So let's talk about it. So D-Wave has some parameters on the new system that they'd like us to try. Some new settings. So we've actually done a number of the settings they suggested, but they have new modules to try. As an example, there's a new way to embed full clicks or fully embedded vertices on the D-Wave. And so we've been using the embedding composite, which is more, a good work embedder. But we use clicks because every stock can be compared to every other stock, right? If I have 4 stocks, I can do stock 1 to stock 2, stock 1 to stock 3, stock 1 to stock 4, and then all the combinations. And so I'm very excited to work with them. And I also realized out of the call that we need to reevaluate our penalty function. So for those that work in either quantum computing or with matrices, you know you can't really put a lot in the matrix. It's just a table of numbers. You get to have vectors. So you get to have a vector and a transpose of the vector. So that's pretty cool. But you have a matrix and a vector. There's no like Excel spreadsheet. There's no logic that you can say, by the way, I need you to only pick the good stocks. So what happens is your penalty function is something you do to modify the data in the matrix and the vectors in order to point it in the right direction. So in our case, if I want to pick a 5-stock portfolio because my client wants 5 stocks, then I need a penalty function that makes 5 stocks normal, but 4 stocks not as good, 6 stocks not as good. And so it'll kind of it'll align the focus towards the best or the answer that we want the computer to find. So it broke. It used to be amazing. In our papers, that was one of my favorite things. But that's when you're running 40 stocks, right? And you could almost manually brute force the penalty function. Well, with 3,600 stocks, you really can't do that. And I say 3,600 stocks because the penalty function has to work on our solvers regardless of whether we're running it on the actual quantum computer or not. And so it has to work for 3,600 stocks. It has to work for 128 stocks. And so it broke. We probably didn't really pay much attention to it. By the way, Clark Alexander and Alex Kahn wrote a paper on penalty functions. So probably should look at that and see what they say. So the other thing to talk about is it's very cool. We started with our client, with our new client. We've had meetings. It's actually really cool. I just wanted to tell you how cool it is. So I can't tell you all the details, but we're working on music and we're working on virtual reality worlds with quantum computers. And so, first off, how awesome is that? So we're going to create something great together, something truly artistic and unique, something cool. But at this point, what does that look like? So I can imagine, like, if I was doing a job interview for someone. So Jeff, I'd love to come work at your company, and I'd like to work on your virtual reality and music client. Well, great. So it's numbers, it's data, it's metadata. Tell me about worlds, tell me about users, tell me about song lyrics, tell me about mood, tell me about all that history. Math, what can we do with that data? How do we normalize the data structures and all the math and the data science of it? And then how are we going to solve it? Of course, we have to solve it on a quantum computer, but we should simulate it, right? I think about like the IBM Q and the D-Wave and all these guys, Amazon and Microsoft and Google, and everyone has regular classical solvers that look just like the quantum computer. So we do the same thing too with our proprietary solvers. We're going to solve it, and then we're going to feed it to the quantum computer and see what we get out of it. I'm pretty excited about that. So that's what it looks like today. It's pretty advanced stuff. It's not like a lot of, it's much more numbers. Is this working? Yes. All right. And by the way, for those who don't know that reference, that was Unikitty in the Lego movie. Traffic to our website, number of unique visitors is up 10x this month without any paid advertising. So first off, I want to thank the world for looking. Thank you for watching the videos. This last weekly video is up about 2 times, again, without advertising. And I realize, Facebook and Google have come out. Google's going to buy $50 billion of stock back because of the amount of profit they're making on their search. And I realize why. So we used to pay for advertising. There were months I paid $1,000, right? I mean, on LinkedIn as well. Twitter, I used to pay for advertising on Twitter. When we had like 9 followers, I paid for advertising because I thought, that's the way I'm going to get up. And I went from 9 to like 90, and I felt, we did great. But maybe sold $310 worth of services for $5,000 worth of advertising. So we're trying it the old-fashioned way. Do great work and see if the world watches. But I can understand the attractiveness when everyone's working from home of trying to get in front of eyeballs. And so I get it. And thank you for watching. So now I'm going to talk something technical, right? So we have been working on our code. And I mean, it works. It's great. But when you start to get all of the listed stocks in the United States, which includes foreign stocks that are listed on U.S. exchanges, sure, it takes a long time. Even just looking through a spreadsheet to try to get some knowledge, manual knowledge about 3,600 stocks times 255 days. I stretch the spreadsheet on 3 screens that I have, high definition screens. It's like the Matrix with the lines of code going up and down. Everything takes longer. Everything's harder, right? So we need a whole new level of Python coding expertise. And so fortunately on our team we have it. And but wow, we're going through our code and we're going to try to eliminate every for loop. Because who knew that for loops were slower? I mean, but they are slower than if you could do the operation on a matrix all at once. And who takes time to actually go identify and work those out? And we've actually gone through our code and we've reduced a lot of duplication and things that didn't quite look right. And we're now in that phase of paying off our tech debt. Because I'll be honest with you, we have a client with a new algorithm they want us to invent. And we're thinking about it, but while the code takes so long to run and while there's things to fix, we're not as focused on the new things, but we need to get there. So if any of you are really good at code, really good at Python and professionalizing it, and you work and live close to Highland Park, Illinois, go to the website, give me a call as well. I've got some money to spend, and I'd like to work side by side. This is not one where I'm going to send the proprietary code to another country or something. This is where you come to the office, we work together, my fingers on the keys, you've given me ideas, and we work it out. So, all right. We did a run this week. We've been running our model this week just to speed it up, test it, recode it. And I put a question on Twitter, and here's the answer. The question on Twitter, let me see if I can pull up that tweet. Always cool when you can do that. By the way, without advertising, we're up to 1,786 followers. That's a far cry from the 70. And let's find it. Let's find it. By the way, here's something I just want to tell people, share with people. The definition of tenacity is persistence of purpose. Tenacity is the ability to display commitment to what you believe in. And to keep picking yourself up, dusting yourself off, and quickly get going again, having learned a little more. Source is Colin Gautry, 2013. It's one of our drivers, is tenacity. Here it is. Only one New York Stock Exchange stock is a better CQ&S score. There you go, better. Only one New York Stock Exchange stock, I want you to think about this, has a better score from our algorithm than if you just held all the New York Stock Exchange stocks with equal weight. So there's one stock that has a reward potential greater than its risk when you compare that to the full New York Stock Exchange. Okay, which one is it? It's based on 255 trading days. Our index is the spider. So I gave a few more clues. The stock also has a high beta relative to the S&P 500 index, and they have not paid a dividend or made a distribution in the past 255 trading days. Third thing I did is I shared just a little more. These are not the stocks, by the way. There are 3 stocks that are leptokurtic, negative skewed, and have high variability in the American exchange. Fury, NAC, and PLX, right? We set a pretty low bar for kurtosis and for skewness. Variability is based on holding all the stocks in that exchange. And the fact that only 3 of them met that bar is interesting. So I want you to think about it. Leptokurtic, they're going to move a lot. They have the potential for a black swan, a fat tail event. Go up, go down. They're negatively skewed. So they've got mean, median, and mode are not the same. Negative skew means they have a potential or a history of going down a lot. Down more than up, or down faster than up. And the last is their high variability, by the way. And so these are things that we throw off in our model. And so I had one person, we had a nice conversation about it, but here's the answer. Camber Energy. I had never heard of Camber Energy until I ran the model. We're going to talk about the market today. The market is down today, and so I want you to think about that for a minute. But Camber Energy, what is it about Camber Energy? So it's traded at like $1.30 last year. I bet if we stretch a little further back, it's fine. We'll do daily. We'll do a line. No, we'll do an area just to take a look. And we'll do it over 2 years. How does the stock look? So basically the stock, okay, there's a lot of words that come to mind, and none of them are good ones. Look at this stock. It's a dog with fleas. It's a goddamn dog, this stock. What the hell's going on? Look at that. Holy cannoli, Batman. If I just focus on 2020, it's basically plummeted in September, just skyrocketed, and is now down again. So to be honest, I never understand stocks like this, right? Look at that crash. Boom. Coming up. So, but the model picked it. If we look at it just over the year, this is what the model picked as being risk-reward profile is positive compared to New York Stock Exchange American. So we're going to take a look at it. I don't have a point of view. I probably should buy a couple shares because the model picked it. So mark to market. It's now 73 cents. So maybe we're calling 73 cents for Camber Energy. But it's just interesting, right? So I would never have known. And so, of course, energy's looking interesting with oil prices up. But what is going on, right? Like, this is a very interesting stock. And so, all right then. So that was something I wanted to talk about from the perspective of running the model and what it's teaching us when we do run the model. So that maybe the rest of the conversation is the rest of the New York Stock Exchange American, or what used to be called ARCA or the Amex. The rest is either really crazy or the intra-stock movements really count in improving portfolio performance. So if you think about it, there's no other one stock that you can just hold. So now you have to start picking multiple stocks and holding them together as a portfolio to beat the exchanges that you see up at the top. And so there you have it. Last but not least about the firm, and then we're going to start talking about markets. So, and I'll mark the time, and that way I can tell people when the market talk starts. But we still owe the world a newsletter for Q1. And we've not sent an email out to our user community in about 2 months. So what should I write about? What's interesting to you out there? Let me know. Come to the website. Take a look. Contact. How do I contact Jeffrey Cohen, President? Well, you can click call our main office. You can call my cell phone. I hate when people do that, but it's okay. Call my cell phone if you're interested in doing business. Send an email. You can get onto my LinkedIn profile and send me a LinkedIn message. I've had people do that. Yeah, there's a lot in there. A lot of personal information if you want to know about me. Here's my address. Here's my email. Here's my Twitter handle. So easy to find. Easy to find. If you have ideas, if you want to learn about things. So there's the one type of person that contacts us that says, Jeff, I'm thinking about buying a run. In fact, I had somebody say that this week. Jeff, I'm thinking about buying a run. I just don't know exactly what I'm going to do with it. Or I had another person said, I want to buy some runs because I have a hypothesis or a thesis that I want to test. And I want you to give me all the data, and I want to do the runs, and I want you to answer one question for me. Which is fine. I mean, we can do that, right? That's expensive. So I'm like, hey, maybe you buy some runs and we can tailor it. But the thing that's important here is if you're reaching out to us, if you're calling my office number because you don't know how to use the model, that's perfectly fine. I got bulls, I got bears in here. We'll code for you. Or you can just have a nice long chat. I don't mind. I mean, if I know you most of the time, you just call me and I answer the phone and we talk. But if you want to set up a conversation and have me do some homework and really dig into a topic, it's like $100. No big deal. Then it keeps us working. Now that I'm paying people, it keeps me paying people. I usually joke around, right? If nobody pays me, this is how I pay my employees. And it's pretty thin right now. Got a couple of 20s. Oh yeah. But that's about it. So buy a run, buy a conversation, buy some coding. But people have questions, right? So they're like, Jeff, find me the needle in a haystack. Find me my own CEI and find it before the market opens. So I want you to look at the data and then I want you to find it before the market opens. And I'll say, yes, sir. Let's go. Find me the most efficient portfolio. Be the oracle. Find me the stocks I need. Find me a bullish stock portfolio. Make me happy. Give me that efficient frontier and give me the one portfolio or 5 portfolios. So actually, we normally give the top couple of portfolios. And all right, you want to be the best portfolio right there, high risk. Let's go. Here they are. And we'll look at 3,600 stocks to get you the portfolio, or we'll look at only dividend-paying stocks, only New York Stock Exchange traded stocks. I don't care. There's lots of capability in the model that we've added, and at the end of the day, we are Better Business Bureau. We are an accredited business. We have an A+ rating, and we work very hard to keep that. And so just know that if you pay us, we're going to make it right, and we're going to help you. We're going to follow all the rules and regs, and we're going to get it done for you. And so it's awesome. Our clients make a ton of money, by the way. So that's helpful. All right, let's get back to it. So now we're going to talk about the markets. Market time. So where are we? Mark to our stream. We're at 27 minutes. Let's go. 27 minutes. Let's see if I can be massively efficient. So the first thing I got to tell you is I'm a bull and I'm a bear today. Bull and bear. Zig, zag. That's why we did the picture. The bull and the bear picture, right? Let me pull that up for you. Today is back and forth day. Okay? And I picked this very carefully because there's no direction right now. There's no compelling thesis that says buy, 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 or sell, sell, sell. It's both. It's bull, it's bear. And so let me talk about this. So we look at the 1 week performance of the market. S&P, Tesla's down, Microsoft is down, Intel's down. Some of the big names. ServiceNow is down. Merck, Bristol Myers, Amgen, Centene, I don't know. Newmont Mining, oh my God, they're down. That must be a company-specific issue. Kimberly-Clark, Clorox, right? There's some stocks down. Probably because of earnings. It's earnings season. eBay's down. Ford is down, which is always interesting. But energy, greener than green. Financial services, banks, insurance, significantly higher. Internet content, advertising. Even Twitter's up a little, even though most people I know don't advertise on Twitter. Tech is up, entertainment's up, retail's up. So I guess what I would say is it's a pretty mixed market. If we look at the world, pretty green for the week. But we look at China and there's plenty of red in there. Big names. We look at the Netherlands. Philips down. I don't know, Kaizen. Well, even Chile's down, Colombia's up. Colombia's been having some issues with the virus. South Africa's down. Israel's mixed. Aussie looks good. I mean, raw materials and commodities look good because the dollar's been pretty weak. So, makes sense. It's not a bad market. It's just mixed, right? So, for the week, mixed. What else we're going to talk about? I thought this was interesting. For the week, you look at the S&P 500, This is for the day. I'm going to show you the week. Hopefully they're still saved. They are. So 1 week, 5 days, and you see the markets reached a fierce crescendo yesterday, Thursday morning. Actually, it looks like right into close. Nope, in the morning. Jumped up in the morning on Thursday. If I remember, that was after Biden's speech. So, by the way, my wife and I, we enjoyed Biden's speech. We popped open a bottle of sparkling rosé, real nice rosé from Italy. That's our drink of choice, by the way, is a sparkling rosé. And with a little rosé, you can appreciate some of what Biden is saying. It's great. President Biden is saying, which is helpful. But now you look at Friday. Friday's down. So I always think this is interesting, though, when markets bifurcate like this. So, and I think it's because of earnings season. So the gray one is probably the most boring. It's the Wilshire 5000. It's pretty big. And so you see how it climbed, though. A real pretty dramatic climb through the 27th. Now you look at purple. Purple is the Russell, the small caps. And this one climbed up, has moved its way down. It's up 2%, not 2.2%, not bad. IXIC is NASDAQ, the composite 100. And you can see here, nice climb. Didn't make it as far. Made it to the 26th. And then pretty flat to down. And so I'm guessing that's earnings related. And so, it's what's nice is we're fully invested in the market. At least I am, Jeffrey Cohen. I've really only got one stock. The other stocks are not so much. Or they're all passive. Almost all my holdings are passive. No direct responsibility over investing in those holdings. But for those who have watched my show before, I've got one stock that I love. My true love. Well, my true love is my wife. My second true love. Absolutely, my love is my wife. So, look at that. Summit Midstream Limited Partners, SMLP. Oh, if you were bored watching the market, you bought a little bit of this a week ago, and you're up 18.7% relative to a market up 1 to 2%. So I actually didn't know what that was going to look like. So I'm actually very happy. My portfolio is very happy. I love Summit Midstream. Now, why do I love it? Well, their earnings are coming out next Friday before the market opens. They're going to issue their press release, and then you're going to read that press release on the earnings call. Some of it is going to be pre-recorded. I love when they do that. It's like, I got to get it just right. I only want to say what I'm allowed to say. But you know what? Let's be honest. I've heard earnings calls where they just go a little crazy, like KLX Energy, and the stock gets killed. I'd rather them focus on what's accurate and right and just say it. But yeah, it'd be nice to take some questions and have a little give and take on the earnings call. So SMLP has an earnings call on Friday. Most times since I've been following this stock, they buy pre-earnings, they sell the earnings call. And so I'm not thinking the stock is up forever right now, but wow, it looks nice. So you can see why I'm in a good mood. But on the other hand, the markets are not committed. So Camber Energy, again, just to talk about where we were. This was the stock that was picked last night by the model. Just in the American Stock Exchange. So if you only had money to invest in the Amex, New York Stock Exchange American, this would be your number one stock if you wanted to only hold one stock. So I might have to, at least on paper, write it down. 73 cents. CEI. I'll tell you next week how we're doing. It's kind of fun. I want to talk a little bit about what we took away from the speech, the joint speech to Congress that President Biden made earlier this week. And there's one thing that really stuck with me. I have a grand vision, and I am going to raise taxes. I am going to make corporations pay. I'm going to make the wealthiest 0.3% of American incomes pay. I'm going to tax the returns on capital. What he didn't say, I'm going to tax dividends, distributions, interest payments, but my guess is that comes as well. I'm going to add a death penalty. I'm going to punish those that make too much money. And I'm going to raise a fair amount of tax on corporations. And so there's a lot to say. So to be honest with you, some of the things I really like 2 years of pre-kindergarten education or pre-first grade paid. I think that's terrific. And I think community college, for those who'd like a 2-year degree, also terrific. To be honest, I can't imagine I would say no if I had a child that at 2 or 3 years old could benefit from some math training or speech training. I mean, I know my kids had a lot of training when they were little kids. And if one of my kids said, Dad, I'd like to go to community college, I wouldn't make them pay. I'd pay for community college, no questions asked. It is a no-brainer for my kids, most likely for your kids, and for the American public. But then he had other things he talked about, and I loved it. Every time he says, I'm not going to raise taxes, I'm just going to raise spending, I always turn to my wife, Diana, and I say, all right, who's going to pay? Raise your hand. We're going to pay. That's all right. So that is something that I worry about, is the tax burden on U.S. corporations. Oh, and we're going to stop them from leaving the country. So we're going to kind of put up like a wall. Like, I think I heard about that. That was, I got to take these off because it's not helpful. There's the Berlin Wall. There's the Iron Curtain. There's the wall in China. There's a wall between the U.S. and Mexico. We're going to build a corporate wall. And then we're going to tax everyone as inside the wall. Again, I'm not very comfortable with that. That feels uncomfortable to me. And so that to me is a big negative on stock prices. Big negative. Inflation's picking up. So I took a look. Producer price index is going up. Costs more to make stuff. By the way, services doesn't cost that much more. It was like less than 1% growth. But to make things in the United States costs more. I get it. Our inflation is picking up. But our inflation is largely driven, I love this picture, by the way, by oil and gas. Oil and gas is going up, and that is driving the market. It's fine. By the way, it's fine when your country is the number one producer of oil and gas in the world. By the way, I still think we need to bring back the XL pipeline. I know I'm a broken record, but our brothers and sisters up in Canada and down in Mexico, they need the gas. They need the oil. They need to produce it. They need to get it to refineries, and they need to use it. And with an XL pipeline, with connecting Mexico to the U.S. to Canada with high quality, high capacity, safe, the most environmentally friendly way to transport energy, you got to do it. So, oil and gas is going up. Why is that? Why is that, Jeffrey? I've been reading a lot about this. So, number one, demand for oil goes up at the speed of the consumer satisfaction index. Right? Hey, honey, let's go for a drive. Hey, honey, let's hire 10 people. Let's rent an office and let's put them in the office. Honey, let's build a factory. Actually, I've been looking for coffee mugs. I got some pictures I want to show you. I want to buy coffee mugs, okay? I want them made in America. How am I ever going to find a coffee mug made in America? Am I ever going to find a coffee mug made in America? Okay. Well, if not, maybe we start making them. Someone should make them. How hard is it to make a coffee mug? So let's say instead of the coffee mug costing me $3.47, that was a pre-negotiated price. I still think it's a little bit high. Let's say it cost me $4.47. I'd pay it. I'd pay it all day long. American-made coffee mug. I bet you I'm never going to find it. I want to find it. Call me if you make American coffee mugs. You call me. Jeffrey Cohen, get on the horn. I will buy 100 coffee mugs with my logo on it and give them out to my clients. Point is, oil and gas consumption goes up quickly. But it takes 6 months to drill an oil well in the Permian Basin, in New Mexico, to connect to the Double E pipeline, which takes a year to build. It takes me a year to build the pipe. It takes me 6 months to drill the well, so it's a duct, to till it, and to have the oil flowing. 6 months, right? So I could use up all of my oil and gas in my storage systems by the time I'm ready to have drilled all the oil. And by the way, the rigs, they're big. There's like 800 of them, 1,000 of them, right? It's not like there's so many. I'm not just going to build a rig like tomorrow. I got to go call Baker Hughes or some of the other companies that do oil rigs. There are a bunch, by the way. So consumption moves fast, is very elastic. Supply moves slower. It's less elastic. So now we're seeing it. Now, the funny part is oil is up, inflation is up. Oh my God, I'm never going to be able to fill my gas tank. Do you know I paid $74 to fill a gas tank last week? That's a lot of money in Chicago. So, there's my point. Inflation picks up based on energy prices. The producer price index goes up, not services, but on things. That's a downside risk to stocks. Stocks don't like inflation, okay? But it's about oil and gas, so you're going to see some benefit, and I showed you that in the stock prices, that you're going to see some benefit from oil and gas stocks going up, but the downside is the average consumer has a certain number of 20s. I mean, I'm laughing, right? I've got a certain number of 20s in my wallet. But it's not like I can't go to the bank and get one more 20. There are Americans, though, that don't have a bank. So when they count their 20s, they're like, all right, I got 8 of them. This has got to make me through the week. And if I've got to go to the gas station and I got to pay $74, well, let's assume my kid wants a drink or something. That's 80. Oh, 80. Okay, now I got $100. So $80. Now I guess I'm not going to go to the grocery store. I'm definitely not getting ice cream. So oil and gas takes away consumption from the rest of the market. Just want to talk about that a little bit. So that's upside for oil and gas. It's downside for the rest. And the minute that India and Brazil and Turkey and Europe get their COVID issue under control, which I truly pray that they do, demand for oil just goes up faster. Okay? So, bullish case, bearish case. You take your pick. Now let's talk about earnings. First off, I love earnings season. Why? Because I learned stuff about companies I never knew about. So let's take a look. What do I got here? I got the streetinsider.com, which I've never used, by the way, but looks like a cool site. Here's just a bunch, right? What they've said is the earnings season beat rate is 87%. They beat 754 and 111 companies missed. I have no idea whether this is true. I've not confirmed the information. But what I will say is I've been hearing that companies are making money. So we're coming out of COVID and profits are up. Profits are up is a positive. That's the bullish case now, right? Earnings are up. By the way, when earnings go up, dividends go up. Buybacks go up. Again, Google, first off, I love this. Let me see if I can do a Google search on it. Google search. Google stock buyback program 2021. $50 billion buyback. If you were wondering, right, how do you support $1 trillion market cap? You buy back 1/20th of that. Holy moly. It's a lot of money. It's $50 billion to buy one stock. I was thinking, if Google wants to grow, they could buy SMLP. They could probably buy 20 pipeline companies if they really put their mind to it. Google could own the pipeline business in the United States, probably within 5 years. That's how much money we're talking about. $50 billion, one time, buy back some stock. This is crazy. It's crazy. So, bullish, bull, keep going. Ooh, don't get rid of other stuff. I have a lot of stuff here I'm supposed to show you. There's a scramble for gasoline because the drivers aren't available. So I will say this. There's a lot of details in this article about summer scramble for tank truck drivers. But one number that I did see, there's a 50,000. So a typical tanker truck carries 8,000 gallons. This is new news to me. So on a day with 9.5 million barrels of demand, or just under 400 million gallons, they need 50,000 tanker trucks just to handle gas station needs. So 50,000 trucks means I probably need 100,000 drivers because some of them are sleeping, right? Maybe I need 4.2 because if I'm going to do 8-hour shifts, that's 4.2. So that's 210,000 drivers to run those trucks 24/7. Okay. Now I know the labor market for skilled labor like this is tough. It's a tough market, hard to hire. That's what I'm hearing. Hard to hire. And the point here was they were saying it's a challenges in getting new drivers certified in schools during COVID. So there's a huge supply chain. Okay, stretches all around the world, and the last mile, or in this case, when it comes to gas stations, the last 1 to 150 miles, could be what drives up the price of gasoline, or drives supply disruptions. So, I don't know if this is bullish or bearish or what, right? This is going to drive up prices. This is going to drive up prices and constraints in our system. You think about the chip shortage. What if there's a gas shortage in the United States? This is not helpful. So I like this article. I don't know if it's true, but the numbers seem right. And you learn a lot when you read this. So I would suggest everybody take a look at Summer Scramble for gasoline. That's pretty important. I was going to talk a little bit about futures. But just to show you on a daily chart, so crude oil's down, heating oil's down, gasoline's down, Brent is down, soybeans are down. It's hard to know what's up, what's down here. Coffee's up, cotton's up. I heard lumber was crazy up lately. So commodities are up and down. Crude oil is down today 2.3%. I normally do the quick scan for you. Gold at 1766 is kind of middle of the road. Silver stays strong. I think that's a specific issue of people wanting to have the metal. And they're trying to drive a Hunt Brothers type shortage of physical delivery of silver. I can respect that, actually. But I think that's what keeps the price of silver up. The euro is above $1.20 again. You know, it's been down to $1.08 this year. See if I can find that. It's not here. It's in a different, what is it? Indices. Oh, here we go. Currencies. I saw that. I was pretty amazed. If you look at the euro, and by the way, this is why it's fascinating when you look at data all day, what you learn about things. It's killing me here. So euro to US dollar, you know, it's been $1.08 this year to to a $1.24, and we're at a $1.20. And I think it hit a $1.21 this week. When a euro buys, when it costs you $1.21 to buy a euro, it means the dollar is getting pretty weak. The dollar's pretty weak. You look at it on the Japanese yen, and this is a 52-week range. If you're over to the right, it means weak dollar. If it's over to the left, it means strong dollar. So let's take a look. Weak against the yen, weak against the Great British Pound, weak against the Aussie dollar, weak against the New Zealander dollar. Well, that's interesting. We're strong against China. We're always right in the middle against the Hong Kong dollar. Sing, we are strong against the Sing. Mexican, looks like we're strong against the Mexican peso. The ruble, we're right in the middle. And there's other currencies. I was wondering whether I would see the Canadian dollar, but for some reason I can't see it here. That's okay. Canadian, so euro against Canada is the same thing as what's up? I bet Canadian dollar is pretty good. We're actually it's important. It's important. So we're mixed. So the dollar's weak. I get that. That's going to be strong for commodities. But when you see commodities being weak, despite the fact that dollar is weak, so anything that's a global commodity should basically go up in price when the dollar's weak. And so when you see things going up and down, it's just a little odd. It's, again, bull and bear. I don't like bull and bear. I like simple. Give me a simple message, right? I'm not getting simple messages. So I just wanted to point out the New York Stock Exchange American from the conversation we had before. I want to talk a little bit about, give me back to that picture. What does a corporate tax rate do? Corporate tax hike do to the stock market? So this picture was not the right. The interpretation was wrong on the picture, but it's okay because it's still a pretty cool picture, and I want to show you. It's hard to zoom in. That's okay. So what this picture says is that there have been corporate tax increases in our history. And what, of course, this chart is doing is it's comparing the year in which the tax hike came out and earnings. And I don't think that's the way you should look at it. I think it should be the year the tax hike goes out and then the next year's earnings, or maybe even 2 years' earnings, because that's when you're really going to see differences. And so here, the tax rate went down a little in 1946, probably during a post-war recession, and in 1950, wow, corporate earnings were up through the roof. We saw another decline in 1964 where we lowered corporate tax rates. And sure, in 64, the change in the tax rate, the change in earnings was up, but it was up in 65 and it was even up in 68. So now let's take a look. The 1968, we raised corporate taxes a lot, it looks like, 5%. 5%. We're not talking like doubling them, maybe like our president is, but just 5%. And you can see, oh, look, no earnings. Garbage. Nothing good happened. And then they lowered corporate tax rate by almost 5%, probably to roll them back because they hurt the economy. And then we're in the 70s, and the good news is when you lowered your tax rates, you did okay. We don't raise corporate tax rates very often, and based on the data, my guess is this is a huge negative for the stock market because it's a negative for earnings. And so let me just give you an idea how this might work. We talked, a couple weeks ago about chips. And I said, so it costs a couple of $1 billion to build a chip fabrication facility to make CPUs. So I can imagine sitting around the boardroom and saying, all right, what do you think? Should we spend $5 trillion or $1 billion and all of our greatest minds and put them there? Or should we build a pipeline? Should we build double E pipeline if we're SMLP and spend years working on it and then arranging the financing and taking all that risk? Well, I heard, new president, they're going to raise taxes. Corporate tax rates going way up, double. So you know how our rate of return calculations, well, we're not going to get all that money anymore. In fact, we're only going to get maybe 60, 70% of it. Well, I don't know of a fab build that I'm going to make that much profit. So maybe I won't build one this year. Or, maybe I'm going to do things around my transfer prices. Maybe I'm going to focus on the wrong things. I'm going to focus on how to reduce my taxable income. As opposed to doing what we're doing now, right? We got paid by a client, bought a server, bought a new machine, bought a Yeti. I'm paying wages now. I'm paying people to work, right? Well, money comes in, the money goes right out again. I love that, though, because that's how our economy works. But what if the tax rate was double? Now the money comes in and I got to think, oh, wait, hang on. I have to make sure that I'm going to not make all that profit. So maybe I don't do the right thing. Maybe I do the wrong thing. Maybe I do the tax efficient thing. That's not good. It's not going to be helpful. Data's not there. And so I had a few more things here. Consumer confidence. A little hard to see these things because they're pictures, but that's okay. But zoom in. The Conference Board reading on consumer confidence. April's reading was 121.7, which is a 12.7 point jump from March and the highest since February. Let's be honest. That's a big jump. That's a 10% jump. So consumer confidence is up. Oh, that's bullish, right? That means earnings next quarter are going to look good too. People are spending. They feel good. They feel positive. They're getting jobs. It's all great. They're probably even buying Harry's razor blades. And so the Consumer Confidence Index, according to J.P. Morgan, Daniel Silver, economist, it's higher than it was before the pandemic. Huge surge in retail sales in March. And consumer spirits remain elevated. So that's good news. There's so many things going on in this market. By the way, I'm not kidding. If you want to sell me a coffee mug made in the U.S., and you can make them in production quality, let's go. All right. Let's talk about bonds. First off, I've never been so bored as when I talk about bonds, but I'm learning. So this is something interesting. Euro area bonds, the next shoe to drop, according to Bloomberg. The next shoe to drop. Come on. First off, I didn't know any shoes dropped. I'm wearing my shoes. I didn't even take them off today. I got nice dress shoes. They're nice. You want to hear them? Yeah. So, Euro area now we're talking government bonds have notched their worst monthly performance against the U.S. Treasuries in a year. And investors are bracing for a bigger sell-off. So what they're basically saying is that yields. So it used to be that the European bonds were considered less risky than U.S. bonds. Less risky. And so that meant the yield, which is the inverse of the price, right? Yield's lower, price is higher. So a European bond is worth more. It pays less. But now, I guess maybe President Biden's right. We're back. The U.S. is back. And so that means Europe is not back. That means Europe is going to suffer. And when their cost goes up, when their bond yields go up relative to the United States, that increases Europe's cost of all the government programs and things like that. And so this is not bullish for Europe, or it is bullish for the United States. I'm not sure which way to take it. And actually, when I looked at U.S. yields, it's another one of those zigzags, right? I'm going to show you some U.S. yields. But this is so fascinating, right? Who knew that Europe is going to have a bloodbath in their government bonds? And by the way, possibly same thing as Japan. They're saying Japan government yields are tightening relative to the United States. And so there's a lot going on here, right? So now I've got to worry. Now, the good news is the United States, right? We're strong. We're feeling good, right? If you're in America. But if you're one of my European listeners, you're thinking to yourself, oh my God, now we're competing for sovereign debt yields with the United States. Now, or worse, people are going to start demanding more yield from my government, which means this COVID thing, right? We probably should have vaccinated a little faster. We probably should have been a little more responsible to our citizens, and driven our economies back up. People do care about the economy, even in Europe. So I got a few more things here. I'm going to probably not show you too many of them. This was something. This is about the advertising. So the companies that are doing well are the ones that advertise online: Microsoft, Google, Apple, Facebook, Twitter. Apple less so. That's always interesting that they put that in there. But so as people are working remotely, the connective tissue between our people, between our companies, becomes more and more important, becomes more valuable, drives more economic value in the United States. And so, but top of mind concern of these companies has also helped shape what is the return to office looking like. So what's it going to be like when I go to an office again? I was thinking about that. I work from home. Can you imagine I have an office? I'm going to have like an administrative assistant. I'm going to have a cleaning service. So how do I set up the offices? Do we do like a bullpen? Or does everyone get their own little office with hand sanitizers and face masks and all that? I mean, I don't even know what we're doing here. Is it like a little home office in the office? Or do we go back to just, hey, how you doing? Right? What are you working on? Right? Not sure. But I think the way that we work has changed, and I think that's going to affect the stock market. Shipping. Okay? Shipping containers plunging overboard. Now, I don't know about you, but there's an author named William Gibson that talked about the impact of a shipping container falling off a ship during a storm. And I thought of that when I saw this article. I want you to imagine one of those shipping containers floating in the ocean. Now, you're in your boat, not a boat, a ship. You're in your ship. You're above the water. Okay? I guess you could be in a boat below the water, and you hit one of those things. You didn't see it coming. It's submerged. It gives me the shivers. People die when that happens. The other thing is these things are going to start washing up on shore. Who owns them? They're saying that there's a lot of money in those shipping containers. Each shipping container has a certain amount of money in it on average in terms of product. And if the product are automobiles, that's one thing. If the product is somebody's crap from their house, that's a different thing. An average value of $50,000 a box. And so, but what I worry about is the number of containers that are lost overboard goes up. That's not that interesting. Okay, that's $300 million in losses in the worst year. What is interesting is the fact that we're loading our ships higher and denser than ever before. And we are focusing on a supply chain that may not be able to handle the increase in economic activity. We may need to rethink our global supply chains. And when President Biden says America first, we should make things in America, one of the reasons is I don't need to worry about the shipping or put it on an airplane, right? And there's no trains over the water. You can't drive a car over the water. Can't ride a truck over the water. You can't even really put a pipeline under the water unless it's shorter distances. So what we're really talking about is maybe some of that $50,000 worth of stuff should be made in the country it's consumed in. This is tough. This I don't know. I'm gonna just keep my eye on it. But I think the whole logistics chain has a lot of issues. This I thought was interesting. So there's a bifurcation in economic returns around the world. And so I was looking at the markets. Of course, the market that looks the best is Taiwan. Taiwan's looking great. The FTSE looks good in UK. Of course, the S&P 500 and NASDAQ. But Sao Paulo looks good. This is the Brazil. But then you come back to the negatives, and you see the Indian market and the Japanese market are down, and you see light declines across Asia Pacific actually. So the market has winners and losers. I think that's important, and I think Japan's seeing more COVID cases, India's seeing more COVID cases. I really worry. I hope they can get past it, and I hope this isn't a bearish wave. I've heard somebody say, right, there may be a variant in the virus coming out of India that might be tougher to fight. If that's the case, we could be looking at another wave, and that's not good for the economy. Beautiful picture, by the way, from a little over a year ago. Robert Kaplan, Dallas Federal Reserve Bank president. I'm just going to read what he said. We are now at a point where I am observing excesses and imbalances in financial markets. I do think at the earliest opportunity, I think it would be appropriate for us to start talking about adjusting those purchases. So you know that we borrow 120 billion. No, I'm sorry. We buy. We exchange money for pieces of paper. We pump liquidity into the system of $120 billion a month. First off, I love it because they probably don't even care what the shit costs. They just buy debt. Now, the good news is they're buying government debt. A lot of it is U.S. government debt, and so we're just paying ourselves. Oh, I borrowed money and I'm paying myself. That's great. That's just left pocket, right pocket. But we also buy mortgage-backed securities. So we're helping to de-risk or take the paper away and replace it with cash. But the minute you stop doing that, let's say you just stopped in one day. Nope, we're done. So everyone's been getting used to 120 billion in money. They probably are scraping the bottom of the barrel. They're digging for bonds to sell. Hey, does anyone have any bonds to sell? I don't know, another 120 billion this month. I gotta find it. And I'm going to make maybe 1% on the money. And then I'm going to get cash. Love it. And I'm going to spend that money. I'm going to invest it in the stock market. I'm going to put it into commodities, currencies, equities. I'm going to buy debt. I'm going to lend money. I'm going to do all kinds of stuff with the cash. And then, all right, it's done. So now it's May. There's no 120 billion. And everyone's like, okay, well, I'm fine. I don't have any extra money to lend. So when I get a call, oh, Jeffrey Cohen, Chicago Quantum, you need to borrow some money to build a factory. I'm sorry, I'm a little tight right now. You could pay a little higher interest rate. I might be able to hook you up. You know, since you're a new company, the junk bond rates, I didn't pull it up, but they're on my system last week. You know, they were hitting 7%. I'd love to get you some money for 7%, but you know, over the year, they've been as high as 18. So I'm thinking maybe we go 10, 12% now. Because we're thinking that the high yields are going to go up. Well, okay, so now my banker friend has less money. Now let's take a look at some of the investment banks, right? That maybe we're going to put some money in the equity markets. And they're like, well, you know, I'd love to buy some stock. There's a couple of new companies I'd love to invest in. I think Tesla is going to go up again. I'd love to put some money in that, but yeah, I didn't get my 120 billion. So we're going to take a look. Hey, look, I have a new customer. Yeah, $1 million invested. Well, maybe we'll buy some Tesla with that. That's not 120 billion, though. It's a couple of millions. And on and on and on. The cash wave is gone. And now there's people, though, that borrow on margin, that have taken some leverage risks. And now those people struggle because they were counting on easy money. Stocks always go up, don't they, Jeffrey? Don't they always go up? Let me show you a chart, Jeffrey. Brooklyn Immunotherapeutics. Don't stocks always go up? Look at that. I just put my money in the market. It goes from $3 to 52. Jeffrey, stocks always go up. So when you stop giving me 120 billion, and maybe I'm going to have to make good on those purchases. So maybe stocks stay at $3 instead of going to 50. That's what I'm talking about. And so when that happens, that is not very helpful. And so it takes more than just one Fed president, one Federal Reserve Bank president, to say that I want to stop bond buying or adjust, trim, taper. You'll hear taper tantrum when people get worried. This is what I'm talking about. First off, I think it's a great picture. I think, Robert, you did a good job. I love that office, by the way. And I think if you can get like Charles Evans out of Chicago, I've met Charles, great guy. If you can get Charles Evans to agree, now we're talking about a couple of different important Fed bank chairmen or presidents that are saying they want to start tapering. This destroys equity prices. Just throw them out the window. Let's take a look at our bond yields. You know, I love this. Bonds. Who knew the bonds were so interesting? I didn't know. Now I know. Okay? Let's take a look at the 10-year. The way you read this chart is the levels, the movements. When they go up, it means higher interest rates. When they're down, it means low interest rates. And you can see that the interest rate was pretty low recently. And it's gone up, but it's kind of get that little squiggle at the end. It's not going up anymore. Okay? So that's 10-year. We look at the 5-year, same shape. The 3-year is interesting. The 3-year barely budged and is flat at 1/3 of 1%. So I'm going to lend my money to the government, and I'm going to get 1/3 of 1. So if I do, what is that? If I do $1,000, 10% is $100. 1% is $1. So for $1,000, I'm going to get 35 cents in interest. And by the way, with the tax rate going up to 39.6, plus any state tax, maybe you live in New York, let's call it 40 to 50%. No, I don't get 35 cents. Oh, and the 3.8% investment tax. I don't remember if that's dividends, but it might be. So now I'm looking at maybe I get 15 cents on $1,000. Why wouldn't I put it in SMLP? You saw the thing was up 18% this week. It's crazy. I'm going to earn what? 18 cents? 18 cents on 1,000 to lend my money to the government for 3 years on an after-tax basis, assuming I'm paying tax on the government bonds. I'm sorry. I don't know what you're thinking. The yield curve in red is the last close. It's still in a positive yield curve, but it's pretty darn low. That's positive for stocks. Employment Cost Index. This comes out of the Bureau of Labor Statistics. So for all those articles that were not helpful, compensation costs for civilian workers increased 2.6% for the year, ending in March. And they increased 2.8% in March. So that actually says March 2020, which is weird. So I'm thinking that's 2021. So they increased 2.6% for the year. So we're still at like less than 3% wage inflation. Private industry went up 2.8. Wages and salary went up 3. Benefits 2.5. Okay. So my cost of benefits is going up a little slower than my wages. Wages are 3%. That's like a 3% raise. So if I was paying somebody $100, now I'm going to pay them 103. All right. That's not crazy. Those are not crazy numbers. Okay. There was all this talk of wages going through the roof. It's hard to find skilled, qualified, capable, certified employees that have skills that I need. That's different than saying I got to pay too much. Now let's take a look at the Producer Price Index from the Bureau of Labor Statistics. So the Producer Price Index increased 1% in March. Final demand prices rose 0.5% in February and 1.3% in January. maybe not that interesting. On an unadjusted basis, which I like, the final demand index moved up 4.2% for the 12 months in March, the largest advance since rising 4.5% for 12 months ending in 2011. So this does matter. Final demand index, the price of final products is up. The cost of making a product that I could sell to a customer is up 4.2%, that index. And it's tied to a 1.7% advance in the prices for final demand goods. So prices are going up. Cost of produced goods are going up. And so energy jumped 5.9%. Final demand less energy, excluding food and energy, was up about 1% and 0.5% respectively. So it's energy driven. It's energy driven. All right. Still real though. Companies are going to start raising prices. It's going to hurt the consumer. That's not good. It's not good. It's good for earnings. It's not good for consumer confidence. You're going to see a little zig and a zag in the market now. All right. So it was funny when I started making the video, which feels like it was years ago. The markets were looking down to flat. Market's actually coming back up. I guess maybe some people are watching. But today's chart for FinViz is still pretty darn red. One-day performance, right? Anything tech, financial, communications is down. Energy is pretty blood red. You don't see a lot of green. I see Tesla. I mean, come on. ServiceNow, Fortinet, Aon, reinsurance company. Not a lot. And so I think it's a tough market today. I think there's a lot of balance in the market. The force, there's a balance in the force. And this was just the other chart that was showing the relative performance of the Russell 2000 in purple to the other exchanges. So we are still seeing the Russell outperform. I shared on Twitter something very similar, that the Russell's up for the year dramatically. And I think that's because of the composition of the people buying and selling stocks on a day-to-day basis have less money. These are not big institutional players. I mean, there are always big institutional players. But the new players, retail. Retail likes to pick on a small company. They do. They do. Let's take a quick look. We're going to wrap up the video. So, but we're going to show you. Look at CEI, Camber Energy. Okay. Why do I care about Camber Energy? Let's look at the summary. It's a $26 million market cap. 52-week range is about 50 cents to $3. If I would have bought it 50 cents and sold at $3, I'd have made a mint. If I put in $1,000, I'm paying my mortgage that month, baby. If I put in $2,000, I might be putting a down payment, a healthy down payment on a car. If I put $10,000 into Camber at 50 cents and I sold it even $2, forget about it. Put a down payment on a house. This is the American dream right here. Camber Energy. It's 73 cents a share. It's a $26 million company. I could go out and tell my friends and tell my social media contacts about all the good things going on at Camber Energy. I could become long and loud, and I can maybe shape my own financial future. As long as you do so in compliance with the Securities and Exchange Commission 10b-5. There's no market manipulation allowed. But as long as you're honest and you're upfront, you tell people, look, I'm long. I bought it at 50 cents. I love this stock. I love the stock. Let me tell you all the good things they're doing. And the stock's at $2 now, and I just made a mint, right? By the way, I'm going to be selling. Oh, sorry, I sold. Made money. I bought a new house. Okay? That's what's driving up the Russell. There's people that still can't go back to work, but they can dabble, right? And now dabbling looks a lot like investing, looks a lot like gambling and speculation and a job that people do. And so the Russell's been up. dramatically over the past year compared to the other indices. And so I'm going to wrap it up with Chicago Quantum. We are an IT management consulting firm headquartered in Highland Park, Illinois. We leverage quantum computing software and hardware to build client value through application development, domain expertise, advanced mathematics, sourcing experience, and management consulting. We've developed our own proprietary algorithms for quantum computing and for quantum inspired and just things that work on a quantum computer that no one's ever tried before. And we have a platform with our own solvers. That's the one that we keep tuning, right? So if you work with us, we have a platform that we own. We have solvers that we own. We have algorithms that we own. And we'll work with you. We'll build your own algorithm if you wanted to own it, or we could work together. You pay us to use it. We own it. We spend all the money to build it. And we pick stocks. And it's nice. We do some other stuff as well. And we are founding members of the Quantum Economic Development Consortium. And we have a Better Business Bureau A+ rating. And we're ready to do business. So please buy a stock analysis. Please buy a project. Or just give us a call and see how we can work together. Thank you so much for listening. Really appreciate it. You take care now. Bye-bye.